We expect Australia's AAA rating to likely remain resilient in the face of slowing economic growth, supported by its strong institutions and policy framework. We forecast GDP growth to decline to 1.5% in 2023 from 3.9% in 2022, due to headwinds from a slower global economy and weaker domestic consumption from still elevated inflation and higher interest rates. Risks are still tilted to the downside given heightened geopolitical uncertainty and stubbornly high inflation. Still, Australia's growth slowdown is likely to be more mild than other developed markets, and we expect it to avoid a hard landing. High commodity prices will also help support growth. China's rapid reopening could pose upside to the outlook by further pushing up commodity prices and facilitating a recovery in services exports. Australia has one of the highest levels of household debt among its peers, which poses vulnerability amid an environment of rising interest rates. Nevertheless, we expect these risks to be manageable. Rapidly rising interest rates since May 2022 are sharply driving up debt service costs for households. Transmission of higher rates is relatively quick in Australia, as most mortgages are floating or set to be refixed in 2023. Higher debt servicing, along with the concurrent decline in house prices, will weigh on consumption. A still strong labor market and healthy household savings should cushion some of the hit to consumption growth and largely mitigate financial stability risks. We also think the RBA is near the end of its tightening cycle, as inflation appears to be peaking. Following 300 basis points of cumulative rate hikes since May 2022, we forecast only one additional 25 basis point hike to 3.35%, and we expect rate cuts to begin in 2024. We see the fiscal deficit continuing to narrow in 2023, underpinned by high commodity prices and a solid tax intake, supported by the still sound labor market. Spending is likely to be more constrained. Risks of fiscal consolidation could emerge if the economy slows more than we expect in 2023, but we view large fiscal stimulus as unlikely, given that this could exacerbate already high inflation. Reducing the deficit over the medium term, however, could prove more challenging, given higher structural spending needs and more modest growth. Currently, we forecast the general government debt ratio to stabilize in the low 50% of GDP range, above the 40% AAA median. We do expect the federal budget in May to give greater focus to addressing some of these medium-term challenges.